Buonasera a tutti e grazie di essere venuti, siete tutti dei valienti perché coraggiosi, a quest'ora eravamo un po' preoccupati del quorum e abbiamo contato su di voi, quindi grazie ancora. La nostra conferenza oggi è una conferenza molto pragmatica per farvi conoscere dove Amiral Gestion è bravo e dove facciamo noi le cose pensando sempre a lungo termine. Abbiamo con noi Rafael Mogò, dei nostri principali partners nella società. Lui è portfolio manager della parte azionaria e sicuramente uno di quelli che ha percorso un cammino con noi lungo e sicuramente lui avrà delle caratteristiche da trasmettere sul mondo del value importanti, no? Quindi faccio soltanto una piccola introduzione per mettervi voi al corrente di quali sono le nostre principali caratteristiche. Amiral Gestion è una società che è nata nell'anno 2003, abbiamo ad oggi 4,2 billion. Una delle nostre caratteristiche principali è che la società si basa su una struttura di partnership, quindi il capitale della società si trova nelle mani degli impiegati. Questo diciamo che solleva un messaggio molto forte nel fatto di dire l'allineamento degli interessi dei nostri coinvestitori sono completamente allineati agli interessi dei nostri propri capitali, no? Voglio fermarmi solo un minuto sulle nostre principali caratteristiche perché il value investing forma parte di noi da oltre 16 anni. Abbiamo lanciato la società e non ci siamo affidati a una moda value, ma abbiamo consolidato la nostra filosofia. Consolidarla come? Sempre pensando a un team di gestione coeso, con un turnover molto basso e un'expertise molto consolidata, no? La nostra struttura gestionale per i nostri fondi puri, azionari e di bond si basa su una struttura di subportafogli. Questa è una delle nostre principali caratteristiche. Subportafogli vuol dire che ogni fondo si divide in diversi subportafogli e ogni subportafoglio ha un gestore che è completamente autonomo di inserire nella sua parte del fondo quello che più interessa, no? È vero che questo viene accompagnato da un forte team, da un forte lavoro di squadra, unito sempre a una autonomia piena del gestore. Quindi questo ha fatto crescere la società in termini di pensare sempre alla qualità del team di investimento. Un'altra caratteristica per noi è che siamo, dicevo prima, una società completamente allineata con gli interessi dei nostri coinvestitori, avendo questa struttura di partnership. E la terza grossa caratteristica nostra è tutta la nostra filosofia si basa sul value investing, un value investing molto flessibile. Noi con il team di investimento parliamo sempre di quali sono le nostre proprie caratteristiche fondamentali. Noi possiamo, quando parliamo di flessibilità sul value, diciamo che noi non ci adeguiamo a quel discorso value versus growth. Noi siamo una società che comunque cerchiamo delle società di alta qualità in diversi cicli di mercato, però che loro crescano. Una particolarità nostra è che siamo molto conservativi nel nostro modello quantitativo. Quando facciamo lo sconto, la valutazione di ogni società, applichiamo una tassa di crescita, una G per quelli che conoscano meglio, una tassa di crescita molto conservativa, a volte all'1% a perpetuità. Quindi in realtà vogliamo che il nostro margine di sicurezza sia un margine di sicurezza molto affidabile, perché alla fine è quello dove c'è il valore nel mondo value, e alla fine ci vogliamo affidare a quel margine di sicurezza non essendo molto aggressivi nella stimazione dei flussi. Okay? Quindi inquadrandovi Amiral Gestion, non volevo mancare nel dire che il progetto italiano per noi è un progetto prioritario. Ci sono qui gran parte del team, un team manageriale, c'è Rafael Mogò oggi accompagnandoci, quindi questo è un voto di fiducia che sicuramente verrà apprezzato da tutto il mercato da oggi in avanti, no? Abbiamo scoperto, per fare la conferenza abbastanza dinamica, abbiamo scoperto uno esperimento che vedrete a continuazione, un piccolo video dove noi ci consideriamo di solito anche contrarians, investitori contrarian, no? Perché alla fine diciamo che cerchiamo quelle società in quelle nicchie di mercato che sono più inefficienti anche, quindi questa è una caratteristica sicuramente di un value investor molto apprezzato, no? Quindi questo video che vedrete a continuazione vi fa capire come tutti nel nostro quotidiano agiamo, anche perché alla fine è uno esperimento, vedrete chi sono gli attori e chi sono le persone che comunque evolgono nella lunghezza del video e avrete le vostre proprie conclusioni che dopo Raffaele potrà approfondire.
The gentleman in the elevator now is a candid star. These folks who are entering, the man with a white shirt, the lady with a trench coat, and subsequently one other member of our staff will face the rear. And you'll see how this man in the trench coat tries to maintain his individuality, but little by little, he looks at his watch, but he's really making an excuse for turning just a little bit more to the wall. Now we'll try it once again. Here's the candid subject. Here comes the candid camera staff, 3 of them at least. And this man has apparently been in groups before. Now, here's a fella with his hat on in the elevator. First he makes a full turn to the rear and Charlie closes the door. A moment later, we'll open the door, everybody's changed positions. Now we'll see if we can use group pressure for some good. Now, in a moment, on Charlie's signal, everybody turns forward. Notice they take off their hats. And now, do you think we could reverse the procedure? Watch.
Do la parola a Raffaele.
Good evening, everybody. So it's very hard not to do what everybody else is doing. It's very hard because it's genetic. There is a kind of common belief in the human being that a large group of people cannot be wrong. If they are all doing the same thing, they probably must know something that I don't know. That's a bit what we are going to talk about today. We are going to talk about value investing. And I think that at the heart of the value investing concept, there is a contrarian mindset. So the capacity to refrain from doing what everybody else is doing. That's a quote from Charlie Munger, very famous investor, the partner of Warren Buffett, leading Berkshire Hathaway. He once said that all intelligent investing is value investing. It means it's acquiring more than what you are paying for. Let me rephrase. It means that to be able to invest intelligently, you must base your decision on the value of things. Other people would say you're trying to buy a buck for 50 cents on the dollar, for example. It looks quite obvious. But if you think about it, many investors don't base their decisions on value as a main criteria. You have momentum investors trying to chase trends or using charts. You have macroeconomic scenarios that are leading many investment decisions. You have index investing. You have thematic funds. You have people investing only in growth stocks, right? And et cetera, et cetera. And all of these people, they might use valuation as, an element of their decisions, but it's not at the top of their priority. While for a value investor, it will be the main decision criteria. Maybe there is often a debate between value and growth, and I think it's important, from the beginning of our conversation to address this topic, because a growth stock can actually be a value stock. If you have a company with a very good prospect that is growing fast, but for whatever reason the market does not want to assign a significant portion of its value for the growth, so it's not pricing in the growth, then it's a value stock because you're paying less than what you are acquiring. And a value stock is not necessarily a company that is only with declining prospects and no future. It can also be a growth company. Whoops. Okay, maybe I'm coming back. All right. So what is value investing? This is a very simple chart. So on the x-axis, you have time. On the y-axis, you have the value. You have the blue line on the top, which is the fundamental value, the intrinsic value of the company. It's something that we are calculating using different assumptions. We can be wrong, of course, but it's something that is really what we are acquiring. It's the value of the company. The yellow line is the stock price. Okay, so as you can see, it's much more volatile. It's going up and down much faster than the blue line. The dotted line at the bottom is the intrinsic value minus a margin of safety. Because the value investor will try to buy a company when the stock price is below the intrinsic value by a significant margin, just in case it's wrong or in case bad things happen. So it means that on this chart, the value investor will buy in the orange area here. Okay? And will sell when the yellow line crosses the blue line at the top. Okay. So maybe he will sell to other types of investor, maybe momentum because the trend is good, or macroeconomic is good, or other. But it will leave the stock at this stage. So what is this chart telling us? Many things. First, that in value investing, there is an analytical component. You must be able to assess, obviously, the value of a company. You can be good or bad at it, but you use a different set of assumptions. You're only, in the end, you're mostly talking about the future, so it's necessarily wrong. But you have this analytical component. But there is also a significant component which is behavioral in nature. Because when you're buying in the orange area here, just as a reminder, you don't know what's going to happen after, right? So you just see that the stock price has declined significantly over the recent past, right? So it means that probably lots of bad news have happened. You have many people wanting to sell the stock. And you may have a different analysis, but you must have the guts and the courage to be buying here where lots of people are selling. It's a bit like when, for example, we invested in Greece in 2015. Okay, even today it's a bad word to say you're investing in Greece, but at the time it was awful. We bought our first stock in Greece just after the stock market closed for 3 weeks because of the capital controls. Okay, everybody, every investor had been burned. It had been an awful market for several years. There was the Greek drama, etc., etc. But actually, in some specific cases, we didn't buy the market as a whole, but we bought individual companies. In some cases, valuations didn't make sense. Our first investment was a refiner that has a refinery based in Corinth. This company was purchasing oil in the Middle East, in Russia, in North Africa, refining it in Greece, on the Greek territory, and reselling this oil, these petroleum products, to mostly other European countries. So this company had nothing much to do with the Greek economy in the end. It was purchasing in dollars, selling in dollars, refining technically in Greece. But in the end, the Greek environment was not so important for them. However, the stock price was very, very low. We bought this company at about 8 euros. Since then, we've received around 3 euros in dividends. And now the stock price is trading at 21. But at the time, I can tell you that, when we bought in the orange part, many people were thinking we were crazy, right? You must be able to look stupid sometimes to be able to make a good investment. Other conclusions about this chart is first, if you buy cheap, well, it sounds obvious, but you have it reduces the likelihood of a capital loss. It's like when you buy good for Christmas, it's better to buy them on Black Friday than a couple of days before. It's probably that you're doing a better investment if you buy cheap. And it also increases the likelihood of achieving higher yields on your capital, because if you buy the stock at the intrinsic value, on the blue line, you make a good investment. This company is creating value, so the stock price should go up. But if you buy it only when you have a decent margin of safety and you sell it when you reach intrinsic value, obviously your yield, your return is higher for the same company. So what is an adequate margin of safety? Well, this is illustrative, so we put figures, but don't take them at face value. Very often people think about value stock, the stocks on the right side. So, companies that are deep value, low quality, challenge prospects. But they can have lots of assets, for example. They can have real estate. Maybe the business is not fantastic, but they can have real estate. They can have stakes in other companies, et cetera, et cetera. But the company is not of fantastic quality. So, and in investment, bad things happen. Bad things happen all the time. You can have an economic crisis. You can have trade wars. You can have Donald Trump. You can have a change in management. I mean, bad things happen all the time, and they happen even more so with low-quality companies. So you want to make sure that if you invest in this company and bad things happen, you won't lose money. Because there are 2 rules in investing. The rule number 1, never lose money. And the rule number 2, never forget rule number 1. Okay? So you want to be sure that if really bad things happen, you won't be losing money. So here, in these cases, you want a high margin of safety. You can also have good companies, but they are cyclical. Okay? So it means that lots of things don't depend on them. They depend on external factors. So you might want to take a significant margin of safety as well, maybe lower than in deep value cases. And you have good quality companies where you might want to take only a 30% discount. Good quality companies will have low cyclicality. They will have high barriers to entry, so difficult for competitors to come and steal their market shares. They have great management team, pricing power, which makes them agile, and they can recover in case of a more difficult context. Here we put 10 characteristics of a value investor. I won't comment all of them because we won't have time, and it's been a long day for all of you. So maybe the first one, long-term investing. Many people say they invest for the long run, but value investors really insist on this because a value investor would tend to bet on a return to average, a return to the mean. And a real value investor is not looking for catalysts. In a way, if a catalyst is obvious, it will be priced in a way in the stock price. Okay? If there is a high probability that there is a takeover bid on a company, it's probably in a way already reflected in the stock price. And we're not looking for catalysts. So maybe just an example of this. In 2011, so it's been some time now, we identified on the Korean market a really weird opportunity, really fantastic opportunity, but very weird situation. A lot of companies in Korea have preference shares. So preference shares are simply shares, but they don't have voting rights. They have the same economic rights on the company's profits, but no voting rights. Usually in the Western world, those kind of stocks, they trade at a 20 to 30% discount to the common share. But here in Korea, you had crazy opportunities, and a big part of the market was trading at 70, sometimes 80% discount to the common share. Very, very intriguing. So we investigated. We talked to many Korean investors, trying to understand what was going on, if there was, a scam there or, something not to touch. But we just understood that, people were saying, well, it's always been like this. They've always trading at huge discounts. I'm afraid that the discount even widens. And some people were just considering them as debt, which was making absolutely no sense because those shares were receiving a dividend. So it was really a weird situation, but there was obviously no catalyst. I mean, there was no catalyst. It had traded at such discounts for a long time already. Obviously, we didn't want to be shareholders of all those Korean companies because, as I said, you want to be there for the long run, and there are many companies you don't want to be invested in the long run, even at an 80% discount. So we identified which companies had decent, good prospects, were of good quality. We bumped into a company called LG Household and Healthcare. They're just manufacturing cosmetics and household products. It's a very Asian business, great quality business. Then the preference share was trading at an 80% discount, and the common share was paying a dividend about 1%. But on the preference shares, it's the same dividend. You were receiving a 6% yield. Every year, you were paid 6% just to wait for maybe this discount to close. Okay. So it looked very interesting. It minimizes the downside if you receive 6% per year. And then we realized that the CEO of this company was purchasing the preference shares. So it looked really an alignment of stars, of planets, and we initiated the position at this time in this company, and it did very well. So the common share has done very well. The company has continued to develop its business in Asia and in other countries. And at some point, a couple of years after we invested, the Korean government pushed all the Korean chaebols to get rid of those preference shares, incentivizing them, et cetera, et cetera. And all those discounts have reduced significantly. So now this 80% discount is only 40%. And the common share has done very well, and we've received the dividends, et cetera. So it's been a fantastic investment. But obviously, if you were looking for a catalyst, you would clearly not do this investment. You must be also able to wait for the long run. I will also comment on point number 4. I mean, you need in a way a strong personality, because in a way, when you think about it, when you buy a stock in the market, it's an arrogant act, because you are saying, I am smarter than the market. In this market, the market is full of smart people that are doing their own analysis, and you're saying, well, I know more than the market, or I'm willing to buy what everybody else is selling. So, and you must be able to defend your point of view. But you also must be able to have the humility to accept critics, to be challenged, to accept sometimes that you are wrong. And that's why it's a constant balance between the two, humility and arrogance, that are necessary to be successful and improve yourself also as an investor. So now we'll talk about the masters. Benjamin Graham, he was a Wall Street professional in the 1920s. And in 1929, he lost 60% of his clients' money in the financial crash. And then he completely changed his approach. There was first a very fertile ground because the market was decimated. So there were many investment opportunities on this market. And he wrote a book in 1934 called Security Analysis. It's been a reference for the investment world. Actually, it's at the library. I saw it earlier today. So if you want to dig the subject, don't hesitate. There are, I don't know, it may be there was 5 or 6 version. And his investment philosophy, was based on assets. So he was not looking too much at the quality of the companies, but more on what they owned. And if they were to liquidate and sell those assets, were they going to be worth more than what you're paying for, i.e. the stock price? A quote from him, he said that the investor's chief problem and even his worst enemy is likely to be himself. And again, we have a quote from a value investor that, that includes behavior as an important element of the decision making. Because in the end, value investing concept is very simple to understand. You don't need to be Einstein, but it's very hard to implement. People, even good value investors, they might be trapped into a tendency sometimes to chase trends. For example, I don't know. We've been invested in Italy for a large number of years, and especially in the small caps. And until a year ago, I was in Milan and meeting lots of companies, and I was a bit depressed because everything was very expensive. After many years of rising stocks, and we invested lots of money in 2012, 13, it did very well. Those companies were of great quality. The economy did, they were very cheap. The economy improved, and we've done, good performances with those companies. But a year ago, even the bad quality companies were trading at high multiples, which was very annoying. And I think there's been a circle where rising stock attracted, as always, people to invest in the stock market, which was fueling the growth of the stock prices and attracted even more money. And there's been a tax incentive, the peer funds in Italy, that has boosted even more the attraction for this asset class, but for bad reasons. And in the end, at some point, the economy got weakened. There's been more political uncertainty. There's been a slight change in the tax scheme for these peer funds, and lots of people got burnt from those evolutions because the small caps really declined severely. 4 important ideas on Benjamin Graham. First, a share, stock is a percentage of the company. So if you want to understand the share, you must first understand the company. The market is there to serve you, not to teach you. Very important. The market is sending lots of signals, and they must not be there to dictate your behavior. Okay, it's as if you had if you own your house, and you have your neighbor wanting to sell his house as well, and every day he shouts a different price. So he starts at 500,000. Nobody buys, but he's greedy. Maybe he's increasing the price 550. Then nobody buys, so he starts declining 500, 400, and 300, and then, hey, my house, I think it's worth more than that. So obviously, if you have the financial capability, you should buy your neighbor's house, right? But in the stock market, it's a bit different. People would tend to believe that if there is a stock price decline, then there's something wrong happening. So I'm going to sell mine as well. Okay. So another teaching is to be able to invest with a margin of safety. And finally, that investing and speculating are 2 completely different things. If you speculate, in a way, you are just betting that somebody else is going to buy the same thing as you just did at a higher price. and it's very risky to bet on somebody else's behavior, right? If you invest, your approach is completely different because you are buying the future cash flows of the company. You are buying what the company owns, and in a way, if the stock market is closing tomorrow, and you cannot sell, the stock that you just bought, in a way you're fine because you're going to collect the dividends and the cash flows, and maybe the company is going to sell assets, and it's more like a private equity approach that a value investor has rather than a speculation approach. We switch to Warren. So Warren, he was Benjamin Graham's student, the most brilliant one. He's the only one to have got an A+ during Ben Graham's 28 years of teaching. And I think what's important to understand about Warren Buffett is the concept of compounding. The concept of compounding, in a way, is the power of time. Let's imagine that to illustrate this concept, that you can grow your money at 15% per year. Okay, it's ambitious, but Warren Buffett did much more than that. But let's imagine, for simple calculation, you can grow it at 15% per year. It means that you double your money in 5 years. Okay? So if you can reproduce this 10 times, so you manage to double your money 10 times, so over a period of 50 years, it means that your €1 will have multiplied by more than 1,000 in 50 years. Okay? So it's a tremendous, it's a snowball effect, and it's a tremendous wealth creation that can be generated if you have a very long-term approach and growing your capital at high returns. And in its beginning, Warren Buffett really used the Benjamin Graham approach, so he was not too focused on the quality of companies, but more on the value of the assets, what he's calling the cigar butts. But progressively, and helped by his partner, Charlie Munger, he really focused much more on high-quality companies that have the capacity to grow and reinvest their profits into their own business at high returns on capital employed. I'll skip this one. But the 4 important ideas of Warren Buffett are, well, first, that you must invest only in your circle of competence, and your circle of competence is different from mine, and only you are able to know what your circle of competence is. Invest in companies with high returns on capital employed, so not necessarily the cheap ones, but the company with high return on capital employed. Invest in companies with solid competitive advantages, companies that are hard to replicate, and maybe more importantly, companies that are managed by professionals or managers that have incentives that are aligned to shareholders. Okay, they must work hard and make decisions that are primarily in the best interest of shareholders. Many times a CEO is here to first keep his job. Sometimes, in the case of family companies, he's here to provide jobs for the rest of the family. Well, Warren Buffett, really insists on, and it's obviously key in the performance of his investments, on investing in companies that really are motivated by shareholder value creation. Obviously, there's not only Benjamin Graham and Warren Buffett. There are other famous value investors, Charlie Munger, so Warren Buffett's partner. He said, always take the high road. It's far less crowded. So what he means by this, invest in areas where there are inefficiencies, where it's hard for other people, to work, in less followed markets or in companies that are tougher to understand. So personally, what I like very much is companies that do not like to talk to investors, for example. Well, very often they are controlled by a family or by an individual, and they just don't care about talking to investors. They don't need money. and they prefer to focus their time on their operations rather than on talking to investors. Very often, those companies are very good quality companies because of this mindset, and they are also cheap because most investors do not know them or cannot have a very detailed knowledge of those companies. We are invested in a Belgian company. We never managed to talk to its CEO. It's one of those occasions where we're happy to be investors of such companies. It's a world leader in its niche. We do our research differently. We don't talk to the management, but we try to talk to competitors, to former employees. We travel to trade fairs to talk to competitors, to talk to their own employees and salespeople who are telling lots of things about this company. And very often, if the stock price is low enough, obviously we don't have perfect information, but we never have perfect information. It's opportunities that can grow and compound very well over time. So how now Amiral Gestion implements those concepts? So it's a bit of our own cooking, but first we never invest in a company where margin of safety is below 30%. We have our own estimates, so we have our own models, and in the case of DCFs, we use only 1% growth into perpetuity to avoid being over-optimistic on the growth prospects of companies. We spend also lots of time on the qualitative aspects of the companies. We have 28 different criteria, so a kind of checklist of elements that are indicating us, the quality of the business, the risks that we are taking. So it's many criteria coming from barriers to entry to capital allocation. So what is the company doing? What is the company doing with the profits it's generating? Also ESG factors that obviously can be sources of risks if a company doesn't take care well of its employees or the environment. I mean, it looks obvious, but it creates risks for the business case. And we try to be as open-minded as possible. We don't have geographic constraints, neither sector limits, to be able to look for ideas wherever they are. So in our process, we have a sourcing part, so identifying the opportunities. We meet lots of companies. Personally, every year I meet 300 to 400 companies, and this generates only maybe 10 ideas every year. So it's looking at many stones to trying to find a gem. Then we have an analytical part that is more DCF, so financial modeling. We spend lots of time on the history of the financial accounts, which very often the history is the best guide for the future. Then we have the qualitative analysis that we just talked about. And then there is the presentation of the investment case. Okay, and every investment idea is presented first in written form and then is challenged by the rest of the investment team in a committee. And here, Francisco presented our sub-portfolio approach. So I'll get into a bit more details here. Very often, a fund is managed by either one individual, so a staff and manager, that has a good track record, hopefully, and you obviously run a permanent risk. That is, well, what happens to this fund manager? He can disappear. He can have bad period. He can leave to work for another firm. He can retire. So obviously, it causes lots of problems both for its clients and for his company. And another way, classic way to manage a fund is a committee. So everybody gathers around the table and decide which stocks are going to enter the portfolio. The problem with this is that very often the best ideas are not the consensual ones. The best ideas usually are in a small corner of the stock market, They are bad news. There's a problem somewhere at some point, or the company has had maybe a bad track record, or and at some point it will revert. Okay? The best ideas usually are here, and it's very hard for a consensus to emerge, to buy those companies. So our response to those challenges is the sub-portfolio approach. So to explain very clearly, a fund is not managed by one fund manager, it's managed by different fund managers who independently manage their own sub-portfolio. Okay? It's not silos, so they don't work in silos like everybody, in his part of the room. There's lots of exchange of ideas. I'm trying to convince my partners to buy my ideas, and I'm trying to steal their best ideas as well. And I'm challenging them, on their ideas, and they challenge me on my ideas. It provides lots of autonomy to everybody, but also the responsibility comes with it. And the problem with the management with committees is that as the most contrarian ideas will be difficult to be accepted by the rest of the team, very often I won't even bother working on them and building my own conviction, because if I have to spend 1 month on a company to develop my own conviction, and then the rest of the team says no, you can't invest, it's very frustrating. So I will spend time on the blue chips or on the companies with at least more consensual view. With a sub-portfolio approach, you can spend the time you want on the companies you want, develop your investment case, build your conviction or not. But if at some point you develop the conviction and you've presented the idea to the rest of the team, it's been challenged, etc., even if everybody else is against your idea, you have the capacity to buy it in your portfolio. Okay? Your portfolio's performance is tracked as if it was a fund, separate fund, and so you have lots of responsibility. Obviously, if you're the only one to buy it, it will be a small position in the fund. So if it's a mistake, then it's not such a disaster. If the process leads everybody to buy it, and if it's a great idea, then it will be a big position. It provides also, especially for the junior people, it's very important because we give them quite early a small sub-portfolio, like 1-2% of the fund, and it gives them the opportunity to express themselves, to tell us what their real convictions are, and it enables them also to make mistakes with their, when they manage a small amount of money. It's better for them to learn when they manage a small amount rather than when they manage big amounts. In reality, very often our junior analysts, they have great performances. So maybe we've been lucky, but it seems to be a good system for young people. Just to illustrate how it works, so Sextant PEA, it's our historic fund. It was launched in 2002. That's how it works. On the left side, it's the top 10 positions of the fund. Okay, so it's what you can see if you read our reportings. And on the right side is what you don't see. So it's our own cooking. You have portfolio A, B, C, D, so 5 different fund managers, okay, because we have 5 different sub-portfolios. In Sextant PEA, there are 96 positions. So it might look quite diversified. I mean, it's lots of positions. Value investors usually are concentrated and don't have so many positions. But if you look at every sub-portfolio, portfolio manager A has only 30 positions, portfolio B has 21, portfolio C has 27, etc., etc. So every fund manager is expressing its convictions in their sub-portfolios. And obviously, you have ideas that are shared. So for example, Iliad is 7.4% of the portfolio. Is shared by portfolio manager A that has 4.8%, and by portfolio D that has 5.5%, and portfolio E that has almost 13%. And maybe portfolio B and C have also a position, but not in that top 10. If you look at Groupe Guillain, which is number 10 in the list, it's shared by at least 2 fund managers. Portfolio A has 4.3% and portfolio B has 9%. So it's very probably portfolio manager B initiated the idea, has a strong conviction on this one, and managed to convince portfolio manager A to buy it as well. And maybe he will tomorrow manage to convince another fund manager. For my part, I will stop here. Let Francisco conclude. Obviously, I'll be available for questions.
Grazie. E come si traduce tutto questo? No? Perché abbiamo cercato di impostare tutte le nostre caratteristiche fondamentali, no? Come abbiamo raggiunto o come abbiamo percorso la nostra storia, no? Come si traduce questo in risultati? Alla fine è vero che noi ci stiamo presentando sul mercato italiano con delle proposte molto concrete, no? Noi siamo bravi, abbiamo un track record molto lungo e molto consolidato su multi-asset flessibile e su azionario Europa. Guardate qui le grafiche, in realtà una nostra ossessione è la generazione di alfa nel lungo termine, no? Quindi battere il mercato in modo regolare per noi come value investing è una priorità e continuerà ad esserci, no? E quindi in realtà noi quello che facciamo un po' come attività giornaliera è vero che abbiamo raggiunto questi risultati oggi, ma cosa stiamo facendo per raggiungerli in futuro? E tutto questo è collegato con la struttura di team che abbiamo, perché quello che menzionava Raffaele è molto importante, la fiducia che noi diamo oggi ai profili più giovani che si sono giunti recentemente nella società e che hanno comunque questa potenzialità e questa capacità per cominciare a gestirsi il suo proprio portafoglio ed introdursi comunque in un gruppo di investimento che li farà crescere, è un aspetto fondamentale dentro del nostro sviluppo come team, come società, no? Questo come progetto a lungo termine è una cosa che noi teniamo sempre a sviluppare particolarmente. Solo 2 dati, Sextant Grand Large, il nostro fondo multi-asset, ha fatto quasi un 10% annualizzato dal 2003, che è la sua data di nascita, con una volatilità al di sotto del 5%. È un fondo evidentemente che ha battuto nel lungo termine al suo indice di riferimento, ma non solo, a 10-15 anni è difficile trovare un competitor che lo stia facendo meglio, no? Quindi anche qui parlare di lungo termine è importante, no? E poi Azionario Europa, Sextampea, il nostro fondo flagship per la parte dell'equity, dove Raffaele ha un subportafoglio, lui illustrava prima come funziona, esattamente uguale. Per Sextampea noi abbiamo fatto quasi un 14% annualizzato, sin dal 2002, e una cosa interessante è che questa struttura di portafoglio ci ha portato noi ad avere sempre dei fondi molto meno volatili dal loro indice di riferimento. In realtà abbiamo fra un 20 e un 30% meno di volatilità. Questo non è una caratteristica voluta, perché essendo comunque dei value investors noi ci focalizziamo sempre sui fondamentali e non sulla volatilità che quel titolo porterà nel portafoglio. Però è vero che la combinazione di entrambi i mondi, la diversificazione da parte del subportfolio con la concentrazione fra i primi 20 titoli, noi abbiamo fra i primi 20 titoli una media concentrata del 50% del portafoglio. Questo vuol dire che evidentemente ci sono 2 caratteristiche all'interno dello stesso prodotto. Questo ha fatto sì che le volatilità abbiano funzionato abbastanza bene storicamente, no? Questa è tutta la gamma dei nostri fondi, perché qui parliamo dei 2 flagship che portiamo un po' come messaggio principale in Italia, Azionario Europa e Asset Allocation, un fondo multi-asset flessibile, però è vero che abbiamo una gamma più ampia su Azionario Europa Small e Mid Caps, che sarebbe Sextant PMI, Sextant Europe, che è il nostro fondo più piccolino che si trova sul segmento Large Caps in Europa, e poi abbiamo Sextant Autour du Monde, un fondo globale, internazionale completamente, molto focalizzato ad oggi sull'Asia, perché una cosa che non abbiamo detto noi è che abbiamo un ufficio di analisi anche a Singapore, il team si divide fra Parigi e Singapore, avendo già a Singapore un team di oltre 6-7 analisti gestori, quindi è importante, tutta questa expertise che stiamo guadagnando in Asia ci sta dando dei risultati risultati importanti per includere alcune società di paesi con un potenziale molto importante sull'Asia. E poi Sextant Bond Picking, un fondo di recente lancio, 2 anni, ha compiuto ora a marzo, un fondo che ha fatto l'anno scorso un 0,8 positivo, un anno molto complesso, sapete tutti voi, essendo coinvolti nell'attività di advisory, la situazione dura che ci troviamo oggi per trovare performance sull'ambito obbligazionario. Infatti questo è un prodotto che stiamo spingendo molto, è un prodotto che ha già raggiunto 180 milioni nonostante il suo track record di 2 anni. Qui l'importante è che lo stesso team di investimento di bond picking è quello che si trova su Grand Large, quindi in realtà possiamo parlare di un track record molto simile quando parliamo di fixed income su bond picking e su Grand Large. Bond picking, l'unica caratteristica, magari spendo solo un minuto qui, è che siamo molto flessibili, è un fondo che comunque cerca le nicchie di mercato, le emissioni proprio che aggiungono valore con un binomio rischio-performance molto adeguato, no? Infatti tutta la parte investita ad oggi di Sextant Bond Picking si trova su corporate bonds con diverse particolarità, ma a noi quello che ci interessa è capire molto bene il rischio di credito, che quella valutazione la facciamo anche internamente, perché per noi non è importante un rating delle principali qualificatori di rischio, Standard & Poor's, Moody's, quello non è importante. In realtà se molti delle emissioni che ci sono all'interno del fondo non sono non rated, forse lì ci sono molto più inefficienze da esplodere, no? Quindi in realtà noi abbiamo anche un track record a livello di default molto positivo. E per chiudere volevamo lanciarvi un messaggio rassicurante sul value investing dopo questo track record degli ultimi 10 anni, perché sicuramente molti di voi a livello quantitativi confrontate le 2 strategie che parlavamo prima, no? il value versus il growth, cosa che per noi questo approccio non esiste. Però noi crediamo che oggi noi ci affrontiamo a un ciclo economico complesso, ma complesso perché non sappiamo leggere il livello di valutazione. Sappiamo che molte economie sono care, sappiamo che siamo vicino o almeno in una tappa di rallentamento. E cosa vuol dire questo? Che bisogna cercare delle strategie che siano decorrelate. La gestione attiva, il value investing, che sono 2 cose completamente unite, vi dà la possibilità di decorrelarvi, credo che si dica così in italiano, di decorrelarvi su un picco di mercato che stiamo oggi vivendo. E quindi quando le cose andranno veramente male possiamo, diciamo, dire che abbiamo un tracking error, quel famoso tracking error molto più alto che la gestione attiva. Questa è una caratteristica. E poi in realtà alla fine il nostro approccio value è un approccio, come dicevamo prima, molto conservativo. L'ha spiegato anche Raffaele, dicevamo prima, noi quei livelli di crescita che dopo il terzo anno dei ricavi, in realtà cerchiamo di essere molto conservativi nell'applicazione della tassa di crescita, perché quello che non vogliamo è acquistare una crescita che non sia affidabile per noi. Quindi da quel punto di vista in realtà oggi, dopo una fase di mercato di crescita costante, è molto difficile leggere se quella crescita lì si compierà anche in futuro. Quindi in realtà quelli che saranno conservativi oggi crediamo che possano aggiungere valore in futuro. Noi finiamo qui, vi ringraziamo ancora per il vostro tempo, sapete, siamo a completa disposizione, avete anche il riferimento e un messaggio finale. Qui in Italia stiamo lavorando con tante reti distributive, è vero che abbiamo noi anche focalizzato diverse priorità di business, però il messaggio è questo: se tutti noi lavoriamo insieme per portare il messaggio sui nostri responsabili di selezione, sul fan selection, credo che alla fine potremmo fare delle cose insieme in futuro molto interessanti. Okay? Grazie ancora.